both are good. Deferral is good, but elimination is better. Elimination is trumped, is the trump card of that. So so let's just take an example. So a deferral is when you have, as a business, you pay a punitive rate of tax on your investment income. And then when you pay yourself a taxable dividend in the future, you get a refund of that tax. That would be a deferral, okay? But in reverse, right? You're getting a refund later. You're not getting the refund now. So that's not really the greatest thing to do, is because you're giving an interest-free loan to the state to give back to you at a later time. Let's take a look at an RSP. Now, this is a true deferral. You put money into an RSP, you get a tax deduction. That tax deduction on your active personal income will be repaid when you start taking it out. And the theory is that you are going to pay a lower rate of tax than you do paying the tax, because you presumably during your working career you're having that. Now, a TFSA is you're still taking your after-tax money and you're now sheltering it inside a vehicle where you're no longer paying any tax whatsoever. I think most Canadians understand what a tax-free savings account is.
Yeah.
So now to your saying about tax-free savings account on steroids, or one that's corporately owned, because TFSAs are only for individuals, how can we replicate that in a corporate setting? Well, if we're using a properly structured, even potentially dividend-paying whole life insurance contract in order to accumulate your retained earnings every year, you're no longer paying tax on that income as long as that money is sitting inside and paid out through a death benefit. There's zero tax on the accumulation. If you leverage it correctly, there is zero tax on the leveraging of that money. And there's different ways of leveraging it, and some can be potentially taxable. So that's eliminating tax, right? You could put it into a pension, right? Which is a very valid option in terms of having a business have an individual pension plan or a personal pension plan. You can do those sorts of things. You're getting a deduction of the tax paid in your corporation, but then you're paying it later in your personal name when you're taking that defined benefit pension out, funded by your company. So company pays tax, gets a deduction, you're paying tax. What are the tax rates? It's still a deferral. It's not an elimination. Again, not saying either one is bad or good. It's, you just have to know the difference, to your point.
No, understood. No, that explains it pretty well. And I think both are good, but like you said, you got to strive for the tax elimination. And I think there's a lot of strategies that can come into play.
I mean, there's a lot of illegal ways to do that too, but we're not here talking.
We don't want that.
Yeah, no.
We don't want that, right? All about legality. And I think people want to pay their taxes. It's not, you're not trying to evade or not pay taxes. People just want to pay their fair share. And I think that's what we're trying to educate people on, that there is ways that you can still pay your fair share without being screwed over, you know? So, or at the mercy of the government.
That's a really good point, because your fair share is also a little subjective.
It is.
If you believe in higher tax and you want to pay higher tax, then you should do no financial planning. But if you don't want to pay that really punitive rates of tax, or you think you're being overtaxed as an entrepreneur in Canada, you have the ability to arrange your affairs in the most tax efficient manner under law in Canada. That's still the basic premise of tax planning, is that we can arrange our affairs in the most tax efficient manner. So why not do that?